Well, hey there, everyone. Happy Thursday, November 20th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of classic overcast fall day here in Redmond, Washington. Speaking of clouds coming in from a sunny morning to a cloudy afternoon, it's pretty much what happened with the markets. If you tuned in yesterday on Wednesday's episode, we talked about the worst case scenario for Nvidia's earnings. We talked about what if they have decent earnings? What if the stock gaps higher? And what if a bunch of people sell that initial gap higher? That's pretty much how things played out today. Earlier in the day, I caught some people on social media doing the victory lap, talking about there it is, Nvidia beats, stock is up, lights out bull market. By the close, I don't know how you can make that argument, right? Because if a leading company in the middle of the biggest, driver of the previous bull market phase beats earnings and gaps higher and literally no one's there to buy it and push prices higher, to me, that is a bearish scenario. That is a bearish sentiment. That is a risk off scenario. When people are not willing to allocate capital to buy allegedly good companies, there's a problem. And I say allegedly good companies. Look, I'm not a fundamental analyst. That is not my training, although I know plenty about earnings and balance sheets and all those sorts of things. I focus on charts and I focus on behavioral psychology when we're talking about investing. Part of that, I think, is recognizing when people are looking past certain things in the belief that something is still bullish. And I think what Nvidia showed is that they're selling a ton of chips. That's undeniable. I think what they have been unable to address, and I think what investors maybe are communicating by the fact that they're selling that earnings beat, is all the issues like the the circular financing between big AI players, with the reliability of AI and the expectations versus the reality of what it's able to do. The idea that the aggressive, if not obscene, investment in AI infrastructure, in computing centers, in all the energy, is going to be worth it and will drive profitability to the point that it'll be a great investment, not 10 years later, but more sooner. Those are things that I would say still are very much open questions, and I think that's the challenge right now with Nvidia. The argument for the market to go higher is that stocks like Nvidia continue to push upwards, and I would say as long as Nvidia and Apple and Alphabet are still good charts, like things are still okay. However, the chart of Nvidia doesn't look very good after the close today. Got a lot of charts to look at today. That's my brief soapbox moment talking about the bubble-like characteristics of AI in 2025. Having said that, let's look at the damage here. So the S&P did indeed close lower, higher open, lower close. That gives you a big bearish outside day. That also takes the S&P 500 below our line in the sand of 6550. So as promised, I will show you the chart of the S&P 500 with an initial downside target, assuming, that line in the sand remains broken through the end of the week. And again, we'll see what happens tomorrow. If you have a big down day like this, super common to have a bit of a bounce the next day, as all of the selling is digested and people maybe think it's not as bad. So I wouldn't be surprised if you have a bit of a bounce on Friday. But overall, I think the message, in my opinion, heard loud and clear here. This is a risk-off environment, and stocks go higher when we're in a risk-on environment. The S&P finished down 1.6%. The NASDAQ composite, which did open higher, also closed lower, 2.2% lower. Sorry about that. Had to pause the recording for a minute. I'm still fighting a cold I picked up on the East Coast trip. Apologies. I'll try to calm down and talk more quietly. I hope you can still hear me okay. I tend to get all worked up when I'm talking about charts. So the NASDAQ composite finished near the lows of the day, holding just above 22,000, but that's still down 2.2%. Mid caps, small caps, all finishing in the red. The only thing in the green on the front page is the VIX, which spiked, as high as 28 earlier in the day. Kind of chopped around in the mid-20s, closed around 26 and change. So the VIX remains above 20. What was so interesting is at the open, when the S&P and the NASDAQ opened much higher, the VIX opened below 20, but quickly accelerated to the upside. And when you see stocks opening higher and selling off, when you see the VIX opening lower and accelerating to the upside, that speaks to the volatility, right? Remember, the VIX above 20 tells us we should be experiencing more bigger percentage swings day to day. That's what the VIX is really communicating to us. It's what the options market is pricing in terms of expected normal volatility for the S&P 500. So VIX above 20 means percentage moves 1-2% should be way more common. We haven't seen as many of those with the VIX in sort of a low volatility environment. We're back to a high volatility environment, friends. All right. Excuse me. Looking at the next page, we can see interest rates generally moving lower, 5, 10, 30-year points all drifting down as bonds generally moved higher today. The 10-year point, which is a key one for mortgages and a lot of benchmark rates in using interest rates, about 4.1% at the close. Dollar, not much change, ended up chopping around for much of the section. It did finish slightly higher. Gold actually finished flat for the day, just like stocks, opened higher, traded lower through lunchtime, but then while stocks continue to rotate lower, gold actually bounced back to retest yesterday's close. So basically finished flat for the day. Silver a little bit lower here, closing about 1.4% to the downside. Copper, crude oil, natural gas, all in the red today. Cryptocurrencies continuing to, I would argue, shout risk off with a megaphone, as Bitcoin over the last 24 hours has pushed up to around 93,000, rolled back below 90,000, currently trading around 87,000 plus. That's down 4.5% today. Excuse me. Ethereum about the same. All the top 10 coins here tracked on the stock charts platform in the red. All right, zooming out a little bit here on the dashboard, I just want to point out the alert. So as promised, I always mentioned, I'm setting an alert for a certain line in the sand. I do that for a lot of individual stocks and ETFs, but a while ago, I set an alert for the line in the sand on the S&P 500, and earlier today, 3:41 p.m. Eastern, it triggers as the S&P goes below 6550. We'll look at the chart of the S&P here in a minute with some updated downside targets. Only one of the S&P sectors finished in the green, and it is arguably one of the more defensive sectors, consumer staples, the XLP, which finished up 0.7%. Real estate, utilities, healthcare were 2, 3, and 4. So the top 4 performing sectors were all the defensive sectors. They all outperformed the S&P today. As a reminder, one of the indicators we look at for structural changes would be defensive sectors starting to lead, starting to outperform. That's why one of the charts on our main chart list looks at those relative lines to look if they're rotating higher. Those relative lines all improved today as all 4 of those defensive sectors outperformed the S&P 500. On the downside, technology, which opened higher but closed much lower. Nvidia, just one of the stocks flashing that pattern today. The XLK finished down over 3% today. Industrials, materials, consumer discretionary come after that. Breadth looked a lot better earlier in the day, but by the close, the breadth conditions were all pretty negative. On the New York Composite Index, which is the most important one in our opinion, about a 3-to-1 ratio with 77% decliners, 22% advancers. On the NASDAQ, about the same, 72% down. On the S&P 500, 70% down to 30% up. So this was another distribution day with real weakness here. As we mentioned, our market trend model, we don't formally update until every Friday after the close. So we'll take a fresh look after tomorrow's session to see if we need to formally make any changes. That change to the model is usually front and center when I do my weekly market update, which is called the weekly flight plan with our market misbehavior premium members. Certainly we will be talking about the market trend model turning negative again this week here. Most likely, again, barring a huge recovery tomorrow, which is possible. But for now, it certainly looks like likely the short-term model goes negative for, I think, the 3rd time, maybe the 4th time, excuse me, since the April low. All right, looking at the Magnificent Seven and Friends, Meta down slightly, 0.2%. Apple hanging in there, down 0.9%. Alphabet down 1.2%. On the downside, Netflix down almost 4%. Nvidia, of course, down 3.2%. Amazon, biggest weight in the XLY, down 2.5%. So what's encouraging here, charts like Apple and Alphabet are still decent charts. And I think that's what encourages me about this market, if anything, is that there's still good charts out there. I mean, there's Apple. I'll highlight when we get to the chart review portion some of the charts that I think are still holding up there quite well. You can look at pharmaceuticals, biotech, some industrials, drug retail. There are areas of the market that are actually looking pretty constructive. There are areas of the market certainly that are outperforming. And that, if there's nothing else you take away from today, besides the fact that I think the evidence remains fairly negative here, would be the importance of identifying stocks with strong relative strength. If we get into that environment where everything starts to rotate lower, we want to make sure if we do own equities that we own things that are outperforming. And that's how you outperform on the way down. That's how you don't lose as much as the S&P 500. That is I would argue, the secret of outperforming for active money managers. It's really tough to outperform in a bull market. It's much easier to outperform in a bear market because you can hide out in things that are lower volatility, tend to move down less, tend to pay higher income. And as a result, you have the opportunity to outperform during a down tape. So this could be that environment where active managers, if they're positioned right, actually have an opportunity to outperform. All right, let's head to the heat map. As a reminder, would love to take your questions. If the charts and the ideas that we talk about here today give you any questions in your brain, please use the comment section on our YouTube channel. Let me know what you're looking at. We're planning an all mailbag episode on Friday. We'd love to answer one of your questions on the show. Nothing is out of bounds. You're welcome to ask about macro strategies, themes, market outlooks, individual charts, stocks, ETFs, technical indicators, routines, whatever you want to ask about. I will do my best to select some really good questions to address on the show. All right, here's the damage on the heat map. And I would say two things. Number one, obviously, this is a pretty rough day. But if you look, it's really concentrated in the upper left corner, which would be technology. The problem here is technology is the biggest sector in the S&P. The problem here is those names that are bright red, most of those are big AI plays or somehow related to that AI ecosystem. Semiconductors in particular stand out, with Nvidia down 3.2%. AMD down almost 8%, Micron down over 10%, Applied Materials, LRCX both down over 6%. You can see as you look around here, the deepest red charts are the ones. Most of those are in the semiconductor space. So really a big sell-off in that theme, in that AI theme. And a lot of these charts, like Western Digital, down another 9% today. These are charts that were accelerating off the April low, almost consistently up and to the right. I mean, beautiful uptrends, higher highs, higher lows, clear accumulation, all completely changing here in the last week or two. And I think that's the change of character that we're recognizing. There have been plenty of leading indicators before these last couple of weeks, but now in the month of November, we're really seeing the previous leadership struggle. And I think that is an important bullet point that I've seen at every major market top I've kind of been that I can think of is whatever worked really well on the way up ends up struggling. Or what's someone said, the heroes in the previous bull market are always the villains in the next bear market. I think that's what you're seeing right now with this concentration of bright red in the technology sector. Outside of that, very few of the Magnificent Seven stocks, if any, were actually in the green today. Amazon and Tesla, two biggest weights in the XLY, were both down over 2% as well. Alphabet down over 1%. Meta basically flat, but Meta has, I think arguably been the worst chart out of that basket of leading growth names up until today. So not too encouraging. You're also seeing weakness in some of the big financial institutions. So Wells Fargo, Bank of America, MS, these are all stocks that made new 52-week highs earlier in this month. I would say technically still making higher highs and higher lows, but the strength of the deterioration is certainly concerning. And I think what you look for on charts like this, right? When you have charts that have been working for a while, You look at moving averages for support, right? So a lot of times the 21-day EMA is an initial support level. If that breaks, the 50-day moving average often becomes a good level. What you don't want to see is breaking the previous swing low. And I think with a lot of these charts like JP Morgan that have made new all-time highs earlier this month, they all have a swing low, that higher low from October, most of them, which would be a really good place to set an alert. So like JP Morgan under 290 is an example of that, right? Because if that would break, and if the RSI would go below 40, that would tell us we're not holding the most recent low. So we're no longer making higher highs and higher lows. That would actually be a lower low. So I think a lot of these charts have a very straightforward level you can look for. And if we see those levels kind of break, that's where I think this market becomes undeniably negative. For now, JP Morgan is still okay, making higher highs and higher lows, but I'm concerned about the moving average breakdowns. I'm certainly not feeling great about allocating a ton of capital right now. I don't see this as an obvious buying opportunity. I see this as an obvious, this could get a lot worse opportunity for now. Nothing would make me more joyful than to tell you all clear signs about improvements in momentum and breadth and support levels being held. That's just not the vibe I'm getting right now. So what was actually up? We've got technology obviously down, a lot of the Mag 7 names down, even some healthcare names that have been very, very good. I mean, I think what you want to look for is anything that was flat to positive today has potential, right? Has potential to outperform in a down tape. Pharmaceuticals are an obvious one. We've talked about the XPH. We talked, I think today I grabbed one of those pharmaceutical names. I forget which one, but a lot of these are making new highs and not showing any short-term weakness. Consumer staples, as you noticed, maybe is the top performing sector today. Now, not a lot of these charts are particularly strong. I'll warn you. I mean, these are generally fairly ugly charts, and even ones that have been working well, like not Procter and Gamble, Altria, like MO, had been really good, like in September and October, but they had these really painful drawdowns. So what actually is looking strong in the consumer staples sector? Monster, right, in the beverages group, made a new 52-week high earlier this week. Boy, not much else though, right? I mean, this might be a really good reason. I mean, I'm doing a pretty manual version of just going through some of these names and remembering what the chart looks like. But this is where it can help to look for scans, right? Scan for stocks in the consumer staples sector above their 200-day moving average. That would be a good sort of initial list to look at. You're gonna find a lot of things like Hershey's that maybe have bounced up, but are still not great charts, right? Because they're coming off a pretty weak levels. So it's not my favorite sector by any means from a technical perspective, but starting to outperform. And if the market gets weaker from here, expect those kind of sectors: consumer staples, real estate, healthcare, right, utilities. These are the areas of the market that generally tend to do better if the market is in a position of weakness. All right, we're going to continue on with the charts again. Thanks for hanging with me. I apologize. I wish I did not have this congestion issue. I'm trying to take it easy, so saved up the energy to do the show, and I'm going to go relax after we're done here. But for now, I do want to say thanks so much for tuning in. Thanks for supporting me and Market Misbehavior. I can't tell you how much I appreciate that. I do want to give a shout out to one of the partners of the show, Seeking Alpha. Been a longtime supporter of the channel. They're running their Black Friday sale on Alpha Picks, which is a product that they have where their quantitative research team goes in there every month and hand selects stocks that score well based on their quant model, which I'm a huge fan of. And then they dive deeper into the fundamentals, the technicals, the story. They kind of highlight these as alpha picks, as opportunities to potentially outperform. Some of the best performing names in recent years have been alpha picks. And if you go to their website now, marketmisbehavior.com/alpha picks, or use the QR code that you see on your screen, you can get a special Black Friday deal, 20% off. Use my link. You'll get a great deal. Also will help me make Market Misbehavior awesome. So thanks for checking them out at marketmisbehavior.com/alpha picks. All right. Here's what the chart of the S&P 500 looks. Here's the bad news. We did finally close below that line in the sand for the first time since September. We highlighted this line in the sand back here, and actually I kind of cleaned up the chart this morning because it was getting pretty busy. But as the S&P has accelerated off the April low, continued higher in May and in June, what I often do is draw horizontal lines, just identifying those higher lows. So I had one down here around 6,200. Remember having one here around 6,350. But as we keep making higher highs and we pull back and make higher lows, I keep bumping up that line in the sand. That's just kind of a classic trend following approach, and sort of using a trailing stop just by looking at the most recent higher. So the most recent line in the sand is 65.50. We tested that in September, again in October, and here more recently today, we have finally closed below that level. Now, not by much, right? This wasn't a huge drop below that level, but I would say this is definitely a bearish outside day with yesterday's upswing, today's downswing. Did take us below that level. Anytime you have a break of a key level of support, I'll look for what's called a follow-through day, which means tomorrow further deterioration would validate that breakdown, and I think confirm an initial downside target for me down in the 6130 to 6200 range. If we would bounce tomorrow, which is not unreasonable, certainly given the acceleration lower, a lot of times when investors have a chance to sleep after a day like this, coming the next day, you have a little bit of a bounce, call that a dead cat bounce. Certainly a possibility for Friday. However, I would say once we have a valid confirmed break below 65.50, I think that unlocks the next downside target. For me, I have this shaded area here in pink as promised. I've added that to the chart. That is basically from two different things. Number one, the 200-day moving average, which is coming in right in the middle of that shaded area here today. And then if you take the April low to this October peak, 38.2% of the way down takes us down at that point. If we break 65.50, which I think, today, the initial break, if we get the follow through tomorrow or earlier next week, I think that would indicate a high likelihood that we continue further down. Test of the 200-day is really not that unreasonable when you think about the context of a long-term uptrend, but would basically also, I think the other reason why this makes sense, if you take the height of this kind of pattern here, right, from 65.50 up to 6,900, it's about the same amount, right, sort of the same amount vertically to get down to that support. So a couple of reasons why that makes sense. Note the momentum here. The RSI is pushing clearly below 40 this week. It's the first time that's happened since the April low. That's not a good sign. We've been following this measure of breadth. 32% of stocks remain above their 50-day moving average. That's in the S&P 500. So that measure of breadth has been diverging from the S&P since the end of June. It's certainly clearly in a bearish territory, continuing to weaken. If there's been a promising part of this chart, it's that we've been remaining above 50% of S&P 500 members holding their 200-day moving average. We are almost exactly at that level at today's close. We're very, very close to getting a confirmed bearish signal from that more long-term measure of breadth, even though the S&P is well above its own 200-day moving average, about half and half in terms of which individual names are holding their own 200-day. This is the newer Dow theory. We highlighted this earlier in the week on our weekly show on Stock Charts TV. You can check that out, excuse me, on my YouTube channel, on the Stock Charts TV YouTube channel. And my weekly show, which is a little later than normal this week, just yesterday was when that went out. But we talked about 3 breakdowns that had me concerned, and one of them was this one right here. The equal-weighted S&P 500 in the top panel, the equal-weighted NASDAQ 100 in the bottom panel, both have made new monthly lows. Both have undercut their swing low from October. That weakness in the equal-weighted indexes suggests deterioration underneath the hood, suggests that even though the S&P and the NASDAQ are just starting to break down, a lot of other things have already broken down, and that is a bearish sign. Sort of a modernization of classic Dow theory. I would encourage you to check out that video on my YouTube channel if you want to learn more about that adaptation of Dow theory, along with a couple other charts breaking down this week that I think are cause for concern. Big red flag with the VIX moving above 20 this week. We're accelerating to the upside. We got as high as 28 today, very close to that green line, which is Ned Davis Research years ago did a bunch of deep dives on historical levels on the VIX and what really differentiated the big climactic sell-offs. And the VIX moving above 29, 28.50, 29, if I remember right, was sort of the cutoff of a really bad volatility environment versus a kind of bad volatility environment. For me, anything above 20 tells me, look, expect bigger price swings. Things like we saw today should become more common as opposed to less common. And we've been in a low volatility environment. Look how low the VIX has been pretty consistently in June, July, August, September, remaining below 20. We had that brief spike above 20 in October, and now we're pushing to the highest level in the VIX since the April low. Right, here's a chart of Nvidia. As we talked about yesterday, right? I think one of the scenarios as we looked after the close and saw the initial gap higher in the after hours session, we said, you know what? Wait till tomorrow, because what would not surprise me is if we have that gap higher on the open and then it starts getting sold. And if that happens, people are saying if Nvidia can beat earnings and if the stock goes up afterwards, that would kind of confirm that AI is not a bubble. And I completely disagree with that general line of thinking. I get it. That's sort of like well, if Nvidia could just beat, then maybe that'll cool everyone off and make people feel that it's not a bubble because Nvidia is still making plenty of money. And I would say Nvidia did demonstrate they're selling a lot of chips and AI is generating a lot of business, but all the question marks about valuations and all the financing issues and all of that, still an open question. I don't think much has changed. And so I think what we see here is, sort of buy the rumor, sell the news, right? Once the news comes out that earnings were good, people were thrilled to cash out on Nvidia gapping higher today. And that open was the high print for the day. After that, we generally trended, pretty low here. Now, to be clear, from a technical perspective, Nvidia is still holding its October low. So while we talked about like on the Dow theory chart, a couple of those equal weighted indexes had broken below their October low. Nvidia is still holding it. Just closed back below its 50-day moving average. It's actually holding its low from earlier this month. However, very close to breaking down, very close to the RSI pushing below 40. However, I would say what saves this market is stocks like Nvidia reporting good earnings and the stock going up. We didn't get that crucial second part of that scenario. Within the Magnificent Seven, you still have stocks that are looking pretty good, right? Apple is still making higher highs and higher lows, although arguably it hasn't made a higher high since the end of October, right? The last couple weeks here, so far in the month of November, we've stalled out and been unable to gain any sort of foothold above 275. This week, we're testing the 21-day EMA. That's actually served as a pretty decent buying on the dips opportunity, pretty decent buy point going back in September and October. So again, if that holds, that's great. However, if the 21-day does not hold, if the 50-day does not hold, that's where this becomes a really ugly chart. It's the chart no longer in a primary uptrend. Apple is one of those names that is still holding up. It's not going up as heavily as it was before, but it's not really going down yet. And I think the doomsday scenario will be the weakness that we're seeing in Nvidia and other charts drags down the good charts like Apple that are unable to hold support. We're seeing some stalls in other sectors as well. Energy in particular today, not really following through. Energy's having had some pretty good days here in the last week. APA, we highlighted, trying to get above 25.50, failing to do so today, back at the 50-day. FANG Energy was one we looked at earlier today, making a new 3-month high. Did a scan for stocks breaking out. I saw that one come up on the list earlier this morning, but here closing back at the lows of the day. So instead of breaking out and confirming a new accumulation phase above resistance at 150, instead we traded above and closed lower, which actually serves to reinforce the importance of 150 as resistance. So the RSI has stalled out at 60. Look how that's happened a bunch of times as the stock has been unable to get above 150. So I think until we can push above 150 on price and above an RSI of 60, I think FANG is still a neutral chart at best. So if semiconductors are struggling, if other technology is questionable, where's the opportunity or what's working? Generally speaking, I would encourage you to focus on relative strength. That's the very bottom panel on most of the charts that I show of individual stocks and ETFs. This is simply looking at a ratio of Johnson & Johnson versus the S&P 500. If the line's going up, it's outperforming. J&J made a new 52-week high today in today's session, while technology is rolling over, some healthcare areas looking quite good. November has been a strong month of outperformance as J&J bounced off of its 50-day, continuing to move higher. COR, which is a medical supply company in the healthcare space, overall above the 21-day, 50-day, 200-day moving average. So moving averages are in the proper order. We're still making higher highs and higher lows. We're outperforming since mid-September. It's not just healthcare. Here's TJX, the old TJ Maxx, making a new 52-week closing high today, threatening $150 a share, which it reached yesterday. Look at the relative performance heading up. So in this kind of environment, stocks breaking out, I think, are always good. As I sign off the show every time, it's always a good time to own good charts. But if we do enter into an environment where the S&P goes below 6550, if these signs of deterioration we've been covering, start to really translate into weaker price action, a lot of stocks could potentially lose value in absolute terms. So where do you go? With the equity allocation in your portfolio, I would encourage you to focus on stocks with improving relative strength, because that means they're actually going up or they're going down less than the S&P. In either case, it's going to allow you to do better than a passive investment product, right? Just riding the S&P lower just because is never a great investment strategy, in my opinion. I'd rather own things that are going up or going down less, and relative strength is going to help you identify those opportunities. Folks, that'll do it for today's episode. Thanks so much for joining me every weekday after the close for Chart This. As a reminder, you can check out recent episodes of our Market Misbehavior podcast on our YouTube channel. Alan Ellman sat down with me earlier this week talking about a specific option strategy called a cash secured put. Kind of an interesting one given the uncertainty we've had in the markets this week. He'll talk about some protective options plays. That should be out to you tomorrow morning, so keep your eye peeled for the Market Misbehavior podcast, the latest episode. But for now, I will say, have a fantastic evening. Thanks for watching the show. And remember, it's always a good time to own good charts. Take care, folks.